Welcome, welcome everyone to the deep dive. Today we're digging into something really foundational, actually, a book from 1919 that's surprisingly relevant. It's Ralph G. Hawtrey's Currency and Credit. And look, this isn't just some dusty old economics text. It's a deep look at how money and, maybe more importantly, credit work. Not just as things we use to buy stuff, but as these powerful forces shaping whole economies. Hawtrey's ideas, they really set the stage for a lot of modern thinking about money, didn't they?
Oh, absolutely. A lot of the tools central banks use today, you can trace the thinking back to him. It's quite remarkable.
So our mission here is to unpack the big ideas from currency and credit, the stuff that still matters, pull out the key insights for you. Okay, so let's start right at the beginning. Hawtrey asks this fundamental question: what is money, really? It seems obvious, but he pushed back on that. He argued money isn't really wealth itself. It's more like a tool.
A tool for exchange, yeah.
Yeah.
A way to get beyond simple barter that makes trade much, much easier.
It's just a means to an end, not the end itself.
Exactly. And the crucial part for Hawtrey was acceptance. Money only works if people trust it. Trust that you can actually swap it for something valuable later on. It's all built on that collective belief, really.
That makes sense. And then he makes this really sharp distinction, doesn't he, between currency, you know, the notes and coins we can actually touch, and credit, which is,
Of
well, it's more invisible, isn't it?
Right. Credit is essentially a promise, an agreement for a future payment. And Hawtrey's big insight was that while we see the currency, it's this invisible credit system that's truly powering the modern economy.
Yeah.
It's the engine under the hood.
Okay, the engine under the hood. That leads to something pretty mind-bending he talked about, how credit isn't just moving existing money around, but how
Yeah.
it actually creates new purchasing power. How does that even work?
Yeah, it feels a bit like magic, doesn't it? But Hawtrey laid it out. When a bank makes a loan, they don't always count out physical cash from a vault. Often they just add numbers to your account ledger. Boom, new money, basically. New purchasing power created out of, well, not thin air, but out of that credit agreement.
So that new number in the account, that is money now.
Effectively, yes.
Yeah.
That newly created credit enters circulation. It pays wages, it buys materials for construction, people use it for shopping. Hawtrey saw banks not just as holders of money, but as active creators of economic momentum. That's a powerful idea.
It really is. But it sounds like, like a power that could be risky, right?
Okay.
A double-edged sword.
Definitely. Hawtrey was very clear on this. Too much credit creation, you get inflation, maybe unsustainable bubbles.
Yeah.
But too little credit, the economy can just seize up. Stagnation, unemployment.
So finding that balance is critical. He saw that as key to understanding why economies have these ups and downs, these expansions and contractions.
Precisely that delicate balance.
Okay, so we've got banks creating this economic momentum. Let's talk about the nuts and bolts. How do they operate day to day within this system? They generate new demand when they issue credit, as you said, and this whole thing relies on the fractional reserve system, right? Where they lend out more than they actually hold.
That's the mechanism, yes.
Yeah.
They only keep a fraction of deposits in reserve and lend out the rest. It works smoothly most of the time, fueled by confidence. But it has that inherent vulnerability if trust disappears.
You get a bank run, people demanding their cash all at once.
Exactly, a classic breakdown of confidence.
And banks influence things not just by the amount they lend, but the terms,
Yeah.
right? Particularly interest rates.
Oh, hugely. Interest rates are like the main control lever. Lower rates make borrowing cheaper, so businesses invest more, people spend more, it fuels economic expansion.
And the opposite happens when rates go up.
Right. Borrowing gets expensive, so spending slows down, investment might drop off. That leads to economic contraction. It's a very direct link Hawtrey identified.
Okay, this idea of balance and the levers banks pull. It leads us straight into what might be Hawtrey's most famous contribution, his explanation of the trade cycle, the boom and bust. He described that boom phase so clearly. Everyone's optimistic, banks are lending freely,
Businesses expand, they hire more people, production ramps up.
which means more demand, higher profits, and eventually prices start to creep up too. It feels good while it lasts, right?
It does. But then comes the inevitable turning point. As prices climb higher and credit gets maybe a bit too easy, inflation becomes a real worry. So what do banks do? They have to react. They start tightening credit.
Raising interest rates, being pickier about loans.
Exactly. And that puts the brakes on. Suddenly, spending slows, businesses might cut back, maybe lay people off, and that's how you slide into a recession, the bust.
And Hawtrey's point was, this isn't just random chaos, it's a pattern.
Yes, a predictable outcome of how the credit system itself works, especially how banks manage it.
So understanding that pattern gives us clues on how to manage it better.
That's the implication. It gives governments and central banks potential tools, ways to perhaps smooth out those extreme highs and lows, try to foster more stable growth.
Now, Hawtrey was writing when the world operated differently, especially internationally. The gold standard was dominant. How did that fit into his picture?
Right, the gold standard imposed its own logic. He explained how, under that system, if a country, say, imported way more stuff than it had exported.
Money, in the form of actual gold, would have to leave the country to pay for those imports.
Correct. And that outflow of gold wasn't just a bookkeeping thing. It directly shrank the amount of money circulating within that country.
Which would then force interest rates up.
Yes, and slow down the domestic economy,
Right.
which eventually would curb imports and help rebalance trade, but often at the cost of, real pain locally, recessions, job losses.
So he wasn't a huge fan of the gold standard's effects.
He was quite critical of its rigidity. He felt it tied countries' hands. They couldn't easily use monetary policy adjusting credit, interest rates, to respond to their own domestic economic needs because they were constantly worried about gold reserves and international flows.
So he argued for more flexibility.
He did. He saw the advantages of systems where a country's monetary authorities had more freedom to act based on national conditions rather than being rigidly tied to gold. A pretty forward-thinking idea for back then.
It's amazing how much of this feels, well, not just economic, but psychological too. Hawtrey seemed to really grasp that.
Oh, definitely. He understood that an economy isn't just equations and numbers. It runs on human behavior, human psychology, especially confidence.
Confidence and trust.
Right? Think about it. Credit only works if the lender trusts they'll be repaid. Consumers only spend if they feel confident about their future income. Businesses only invest if they trust there'll be demand. Banks only lend if they trust the borrowers and the overall economic outlook. It's all underpinned by belief.
And that belief is fragile, isn't it?
Extremely. When confidence shatters, maybe due to a crisis or just widespread fear, the whole thing can unravel fast.
Banks pull back lending, businesses can't get funds and might fold, unemployment spikes. It feeds on itself.
Right. It becomes a self-fulfilling prophecy driven by that loss of trust. So Hawtrey knew that policymakers couldn't just focus on the mechanical bits. They had to consider the mood, the sentiment, the expectations of everyone involved in the economy. The human element is key.
Which leads nicely to his view on the role of government and central banks. He didn't think these markets should just be left alone, did he?
No, not at all. He was a strong believer in an active role. He argued that credit markets, because they are so powerful and prone to these cycles and confidence issues, need guidance.
Guidance from who?
From governments and particularly central banks. He was really advocating for the strategic use of the tools we've been talking about. Things like adjusting interest rates, the bank rate, as it was often called then, controlling the overall money supply, and crucially, acting as a lender of last resort, providing liquidity, basically cash, during a panic to stop the whole system from freezing up.
So like lower rates in a slump to get things going again.
Exactly. Encourage borrowing and spending.
And raise rates if things get too hot to prevent runaway inflation.
Precisely. Cool the economy down a bit. These are the core ideas behind modern central banking, really.
It's incredible. His analysis from 1919 basically laid out the playbook that central banks around the world are still using in various forms today. That relevance is just striking. So wrapping this up, Currency and Credit really feels like more than just a book about economics. It's almost a guide to the underlying currents of how our societies function, financially speaking.
I think that's fair. It shows how money moves, how credit fuels activity, and how trust is the essential lubricant for it all.
And it highlights those patterns, those cycles of boom and bust, suggesting they aren't random acts of God, but things we can actually study and potentially influence.
Yeah, understand and maybe even manage a bit better.
For anyone out there wanting to get a real handle on the heartbeat of a modern economy, Hawtrey's work still offers so much insight. It's a solid foundation. So here's a thought to leave you with. Reflecting on all this, what really strikes you about the immense, often invisible power that credit holds in our world right now? And hey, before we finish this deep dive, just a quick mention. If you enjoyed exploring these economic ideas and their lasting impact, there's a whole universe of audiobooks and podcasts waiting for you. Just click the link in the description for this dive. You can subscribe to Audible and get your first month completely free. It's a great way to keep learning and discovering. Thanks for joining us.